Hello, everyone. Hopefully, we're off and running. I think I've managed to click the mute button today, so we might be off and running. Advertising. Woo. Here I am, chief of the clan. Thank you, Julie, for that. So, how's everyone getting on? It's a bit of a quieter start to the week, isn't it? Really. Yeah. Hopefully, you all saw George's announcement today. Just, we all had a big chat at the weekend, and he's upping the communications, and that is a very useful update for anyone that's waiting for payouts, etc. Obviously, we've got France to talk about. Is the euro isn't necessarily loving what it's seeing. Not surprisingly, that is fudge extraordinaire. I think the volume's fine at this end. You're just going to need to adjust at yours. We are on max. Simon Birch from Cambridge, just up the road. Brilliant. How are you getting on? What are you trading? Brilliant. Thank you, Julie. Yeah, it's, I think it's the first time people join, you have to do something to get this to regularly be louder. So yeah, obviously, I'm very surprised about the headlines coming out from the market news services about France. This was all sorted as of the middle of last week, where as soon as they agreed to stand down, the left and the centre of fighting against each other, then it was a absolute fait accompli, as they would say. There was very little chance that there was going to be any inroads made by the National Rally, the right party, unless there was some mega event to do with the participation rate and suddenly drumming up a load of support out of nowhere. So you've got it's not like over here where Labour won with almost the same vote as the Tories. In fact, the Tories plus Reform was bigger than Labour, and yet Labour gets 170 seats majority. It's the problem with first past the post over in France. National Rally were going to be the bigger of the three, but if the other two club together to make sure they win each seat, then that's what you get. It's absolutely ridiculous. So Euro, US dollar, we'd said it'd have a little rally over the weekend, and we'll see what happens with the fudge. And the market isn't overly pleased because I always talk about Jean-Luc. He's my Europhile friend that always manages to find an unexpected consequence, the law of unexpected consequences. And he's literally called Jean-Luc Mélenchon in charge of the left. He'd forgotten the agreement. The whole point was stopping the right getting any bigger so that they'd have gridlock. And now all of a sudden he's trying to say that the country's voted for the left, and it's absolute nonsense. They're just going to be gridlocked, which obviously the market is happy that it's not a disaster either way, but isn't great for down the road. And France is going to be hamstrung until 2027 by the look of it. So as long as they don't end up allowing the left to do anything dangerous from here in terms of fiscal policy, it'll be all right. In fact, an old colleague, Paul Donovan, I talk about him quite a lot, very quality economist at UBS, he came out and said, if you want to think about what the damage could be done from the left's fiscal policy, it would be a double Liz Trump effect. So that is why we've had all this shenanigans with oats versus buns, the French bonds minus the German ones. And although that has calmed down, let's see if I've still got that. they've still got issues ahead potentially. So I've still got that. Yeah, there you go. So can you see that? That is, yeah, that's showing 10 years French bonds minus German. The premium obviously shot up a big. It's pulled back, but it's still elevated relative to the last few years. Being in this zone still puts it at decade highs. So people aren't that enthused so far because there's a lot more detail to come out, and hence the euro has pulled back a little bit. Bletchley, you've been informed that US unemployed do not go on the numbers until after 3 months of being unemployed. Um, yeah. Um, I'd have to double check that, but I know that that's probably for the continuing claims, isn't it? The initial claims data is kind of in the immediacy. The Yeah, continuing claims are definitely about, if not 2 weeks, a month behind. Blah blah blah. But the nuance, the real nuance to be aware of for claims in the US is that if you want to take a job, you have to, yeah, you have to sign on. That is why it's important to follow those numbers. So even if you're going to move around, you have to be in the system, and that is why their data is really good. If you go into those other two reports on a Friday, household and establishment, because you can see who's participating, how long they've been on. So in the GFC crash, it was quite important to be all over that because you needed to know when that was going to turn. There were some people had been on continuing claims for so long that they actually thought they'd never get a job and they came off, which was giving some false signals back then that things were getting better when they weren't. So you do have to keep a look at that. So there's a reasons for leaving for not economic reasons. That's basically giving up. So all that data is really good, which is why I always say go and have a look at it straight away. And that is one of the things I did want to talk about from the preview, um, which is the whole issue with the quality of it. We've talked about non-farm payrolls being um, a strange number, that there's going to be an adjustment made. I think it's been overestimated by 60 odd thousand, but there's this brilliant thing from Don't Walk Run. They look at trends and some quite weird stuff. But they put together the last 18 months of the jobs report on Friday. Now looking at, there's only three instances of actually being a revision. So we talked about before, it's all about revisions and on-farm payroll. You get the initial headline, and then the next 2 months, the previous data will be adjusted for the previous two reports. So on Friday, there was 111,000 adjustment down from previous reports. And as I said, 54,000 was taken off, which is, they've got highlighted here. 272 became 218. Now, I've still got people talking about 206 is only a 12,000 miss on the month. That's dreadful reporting and bias painting, blah, blah. That was a 54,000 miss from the previous report. Take it for real. And it's going to have another adjustment for next month. 15 out of 18 months have had net over those two adjustments negatives, and they still think it's overestimated. So I said non-farm is not NFP, the establishment side is tricky, and we should be looking at household. And again, the unemployment rate went up, and the participation, the civilian labour force went up, which again could be due to the people signing on, which you say there is a backlog and that is increasing. So I think the data for jobs is soft, and within that 206,000 that we saw, there was 70,000 of government. I was petulantly saying when I was reviewing ADP that the time to worry is when private is less than government. Well, it wasn't actually far off on Friday. It was 132 private and 70 government. So they have got a problem and they need to address it. So Powell talks twice this week, Tuesday and Wednesday, in front of two Senate committees. One's what they used to call the Humphrey Hawkins statement, and I'd like to see him put under a bit of pressure, really, because we've got a lot of things going quickly, and I said that they go quickly. I'm just surprised how little rhetoric. I mean, September's coming back in, but the July, etc., is totally written out, and the period in between. If you get a negative CPI on Thursday, which is a potential, if remember the only thing that hasn't dropped yet is rents, but that is 36% of that index, massive. So if you have, we're waiting for the time when, and they expect it themselves, the Fed, that is going to go negative. If you go from being plus 0.4 to suddenly minus 0.2, that would be a 0.6 change, and 36% of that negative would come off the numbers. That'd be literally 0.2 drop. They're already expecting it to be 0.1. So you could have a negative print on inflation this week very easily. And what would they say then? The whole combination. So you'd then be talking about potentially an emergency rate hike, so a rate cut. So there isn't, just don't get falling in love with just listening to the talking heads and the media guys. This thing's a lot closer to potentially seeing a rate cut. They don't have to do it at the meetings. They could do it in between. So if they don't do anything in July and they get, this continuation of negative results, they could go out of meeting. That's happened loads in history. So don't get yourself into the idea that they can only go at the meetings. That isn't the case. What we've got there, what we're talking about there. You've had average wages have been dropping. I would say this supply greater than demand. Yeah, definitely. That's the other angle. You can't really negotiate for a job that hard unless you're knocking it out of the park. When there's a queue of people outside the door, you're going to come in on as low as the firm wants to offer. So yeah, that is where the pressure comes from. You saw some jerseys written Alpha Futures. Z. Where are we? Ooh, Alpha Futures. Can we see that? Yeah, Alpha Futures. We've done videos. They're up and running. If you have a look at the Alpha server, people have actually qualified already. They're funded. So, we talk about it a lot. That is the daddy boy place of trading. It's where all the proper price discovery is done. There's no slippage. You're not going to get, where like you see a lot of the complaints in the CFD world, the pricing in futures is centralized. So that is something good for you if you fancy it. And as we talked and reiterated at the weekend, if you qualify as a funded trader, then you've got an opportunity in futures of building a track record that you can maybe take somewhere else. So there's a real attraction to join that party. Hopefully we'll see you there. Yeah, you should. I don't know if you've got to click something on the website to get access to that. Maybe anyone on here can tell you, or on my chat. But certainly get yourself over there and engage with Ben. He's there for all questions, and we need to engage a bit more on it. But there's a dummy double site of mine. We need to start talking in the futures world as well. So more of that to come. Boom, boom, boom. So yeah, ISM. I was saying the ISM is a big thing that you should be looking at, and that came in the services side. 70% of the economy. We said that was going to be something to watch. Came in as a big miss last week. That got everybody excited as well. It's very rare you get both of them in negative territory and not be a recession. So in 2020 that happened. What did we get? So that was April and May. They stayed below there. December 22, April and July were double slowdowns. So there's every chance that all this data keeps getting revised down. GDP keeps getting closer and closer. This stagflation idea. I think we've got to be careful. The inversion of the yield curve has been so inverted for so long, and that is normally an indicator. New orders need to break out to the upside. They're starting to slip back in those ISM reports. These are all things that the Fed should be super scared of, rather than panicking about what we said last week was a 20% probably reflation event. They could be well behind the curve, trying to find a perfect time to say, "Let's go." It's not. It's unlikely to happen. So gold that people were looking at and talking about yet again the first week of a month. You've obviously got the end of the month out of the way, and then you can get the headlines from the news services, but the actual data points are very hard to find. So China again hasn't been purchasing, so that was used as a reason for selling off. But people are ignoring the fact that there's also data out there showing you how India have been buying over June. It's not rocket science. The fact that they're all part of the BRICS, and they're all trying to grow. All central banks are trying to grow their reserve assets for the potential of, well, two reasons: the potential of the BRICS hard-backed currency, 40% rumor of gold being in there, and this other thing that I keep going on about, the 85%. If you want to have it as reserve assets, you need to have 85% of that in physical, which is causing real issues of supply in the market. So what I do is go into the website, the People Bank of China, which you can probably see there. And then you want to go into, where have we gone? Statistics. You need to go into data. Just trying to make sure I get you the right link. So you're into 24. So we're in the year 24. Money and banking statistics. So this is all available free, blah, blah, blah. And then we want to see what they've got as official reserve assets. So that whole 85% thing I've talked about is gold is now a reserve asset alongside the dollar, but you have to own 85% of it. I keep going on about it because every time I talk to someone that trades gold, they don't know when I ask them. This everybody, on my chat we're going about it. If you read my preview or watch the lives, I go on about it. But for whatever reason, the market at large doesn't want to talk about it. It's bizarre. I've never seen anything like it. Anyway, you click on the XLS and it will bring you. Well, you want the PDF because there's a problem with the X, and it brings you up this PDF. If you look through it, this is gold. Their gold holdings in $100 million amounts. So last month it was 1709 spot 6. It looks like it's gone down there, but you have to make sure, you have to confirm that, because that is literally the amount of dollar value of their holdings. But obviously it depends on what the end of month price was. But I've had a look. It literally is more or less the same price, 23.26, 23.97. So from my opinion, working it out, then they owned 22.95 tons of gold for their asset account at the end of May, and at the end of June they own 22.79. So if anything, rather than not buying, they've actually sold 16 tons somewhere, so that even the reports haven't bothered to go in and look at the number. And that's assuming that that is priced to the end of month price and not on average for the month, because in which case I'll have to maybe Deva A, if he's on, the Indian guy, he's obsessed with levels intra-month, intra-week. But there's half a chance they passed in the night because we got that up and down through the end of May into June, blah, blah, blah. But either way, they're not necessarily buying for their reserve asset account. But remember, they've got 2,279 tons in that account, the one that is their official reserves. But in China, there's, using all their agencies and the amount that's held locally, they've got about 30 odd thousand tons. So they're not really that bothered. And surely there is this issue with the BRICS wanting to get in there. So not surprisingly, India are buying. They bought 9 tons this month. So there's 32,000 ounces in a ton. If they need 85% to back that, they need to buy 240 odd thousand ounces. I think I worked it out as. Let's have a look. Yeah. Yeah, so India, which doesn't get talked about as much, even though we know that they do have a massive retail market. They bought 9 tons in June, which is their biggest monthly purchase since July 22. But they've bought 37 tons in 2024 to the end of June. So they are buying a reasonable amount. Um, yeah, so there you go. So 32,000 ounces times by 9 tons is 288,000 ounces of gold. 85% of that is 244,800, which is, I think that's actually above the amount that gets mined per year. So that's quite a reasonable amount of gold to find when it's already in short supply. So it all adds up to why there are physical buyers out there. And they don't all. Every physical buyer is not China. China apparently is there buying below 2,300. Blah blah blah. So bytes, I don't know what it is. You'll have to work it out at your end. It's something to do with YouTube coming into this setup for the first time, but everyone else has managed to get it going eventually, I think. Thank you, Simon Birch. Catch you later. Thanks for attending. Um, so Ben A, obviously, yeah, we're back end loaded for a couple of things this week. One is CPI's Thursday and PPI Friday. Powell is speaking midweek, so some people may be holding on for that. And also, this is the first proper week of American and some of the European stock market updates for Q2, but it doesn't really start until Friday when we've got quite a few banks coming out, which you can see in the preview sheet. Doesn't really happen, but we've got Wells Fargo, Citi, JP, I think. Yeah, JP, Wells Fargo, City and Bank, New York, Mellon on Friday. So that will give us a good guide to where we're going straight away. Some of the heavyweight financials. But prior to that, I mean, we've really got Pepsi, Man United, WD-40. It's not really a big roster. You can see there. And that was all I pulled together. And then I came across this late yesterday. So it is, and looking through the whole raft, there's very few of the big heavyweight stocks on the roster. But back end of the week, that's when the action should probably start, unless we get some geopolitics, which the guys have been talking about on my chat. We've got a few Israel things, haven't we? We've got potential Ukraine having the heat turned up again, and we're just going to get more and more BRICS info as we go through the summer. So be aware, there's lots of underpinning for gold. It doesn't mean they can't try and get it down, but we'll look at the chart that I think we're on later. I still think it's still looking like June the 7th was the low, but there's a couple of options. So any questions on central bank data? I still have, I mean, I've tried to go to the Indian one so far. So unless you see the news items, you don't really get to see that. And I haven't got my old Bloomberg access at the moment. So it's difficult to get in and see an official release. If anyone comes across the actual official release by all the central banks, that'd be great. But I haven't seen it. And ironically, the World Gold Council are months behind on data that they have in their spreadsheet, which is ridiculous. So it depends. Roland asking what I trade. I trade all sorts of things. I am actually trading gold at the minute. And Nasdaq has been something I've been trading. I trade stocks as well. Sometimes I'll play around in other indices. Sometimes in the currencies. But it's got to be. I'm more swingy at the moment rather than intraday trading. So it's a good question, Ben, which is what I said. Their official asset reserve account, the one that they have to have 85% of, is what they show. But there's been some very clever people put counts together, going through all the government agencies and the public buying since 2000, and the imports and what is in the Shanghai, and all the mining companies that are in China. All that gold added in, because that's not allowed to be exported. It all adds up to about 32,000 tons of gold. So forget what America have got. They've got 8,000 supposedly, and some of that is potentially being used to lease and try and keep the price down. They have been known to manipulate over the years, but no one trusts the government in the US, do they? So there's very little chance that their gold would be the companies in the US would be interested in committing anything to a national program involving gold. So you'd have to take it at, as you know, in black and white, what you see that they've got around 8,000 tons. But you've got everyone else, buying loads. 100% of reserves in Turkey are gold because of their inflation problem. Central banks, when there is when there was a gold, the central, what do you call it, the gold standard, everyone had between 40 and 60% in gold. When ever since they came off that in the 70s, they've been drifting back down to around 10%. Gordon Brown sold a lot, brilliant for the UK. Right at the bottom, bought houses at the top. But now there's a trend, and there's a trend to potential hardback currencies needing to own it. There's every chance that percentage is going to at least double. At the moment, it's averaging around 15 to 20. Highly likely to double. The amount of gold required to make that happen suggests that no one's going to let that go cheap, which is why all the investment banks are moving their end of year this year targets to around $3,000. So once this thing's definitely sorted out and we start moving again, look out ahead. There's a lot of upside in gold with seemingly, unless we do go into a rate hiking cycle, nothing really to get in the way, because every time it comes off, these paper traders are now hitting gold, real physical gold traders. They have to find that. They have to borrow it, which they eventually have to buy back, or they have to go and buy it straight away. But I can hear you. I appreciate it. I'm sorry if you have got volume problems, but you've got it on max here, and half the viewers are okay. So don't know why it is, but there must be some back end YouTube thing to fiddle with. So yeah, so CPI, PPI, we know that we're expecting that trend to probably continue. They broke the back of airline fares. A lot of the insurances, healthcare is still a bit sticky. We've got rents to potentially come off, and the rate of change of the advisor fees has slowed down the professional services. So again, it's set up for some pullback. Apparently, there are some year-on-year base effects which might keep the year-on-year number still elevated, but it's all about the trend in the monthly at the moment. And like I say, there's an outside chance that could come in at zero or even negative, which would get the whole thing going. Hi, Fato, good to hear from you. Again, we've got the Biden discount. So the start of last week, data had been poor, rate negative, dovish. Yet the whole debacle with Biden's performance, and that's continued to rumble on with more and more people sharpening their knives, trying to stab him in the back. He's determined to hang on. So we had the first 2 or 3 days with yields backing up, but it didn't stop. Didn't stop the TLT, which is the ETF for bonds, seeing inflows. So as you can see, last week, despite the fact it started off a little bit negative, had some outflows. People bought into that negativity via ETFs, and the actual 10-year US dug in as well. So we've been following that for that outbreak. We've had a deep consolidation through all the political nonsense. Data started going the other way, and that looks like it's back in at least a 5, consolidating and push on again. This is hinting that we're going to go back into that channel for the rest of the upside of those waves, I think. So that is going to hopefully give us a nice backdrop in general with a weaker dollar, et cetera, which we'll have a look at in a bit. And Torsten Slok, the guy he's quite a bear, quite a hawk on rates, but he was talking about the oil situation, like I'd mentioned a number of times, about the reason that the OPEC cuts aren't having much of an effect is because the US are pumping like crazy. They're filling the whole gap. And something that hasn't really happened before is this: the oil in the US, they are officially pumping more than they're consuming. So absolute classic of pump and dump. Global demand is kind of helping, but the OPEC have had to throw in a little bit of their price manipulation to try and get this thing going again. Oil very close to a topping out, I think, which is the plan. The US will keep doing that until election. They are determined to try and help the whole inflation thing. That is in the non-core stuff. That's headline inflation. They're trying their best to keep the energy component as low as possible. Are there any things that you guys want to talk about before I just quickly run through the rest of the preview? I thought that was interesting, despite what the midweek before they did the carve up. I was just showing you that the reason they were scared and they carved things up is that you've had this move to the right in France ever since the Le Pen started pushing. And you can see in the last 10 years, it's really started to get momentum. They're up to 34% last week. The worry was they were going to get that 40 odd, 45%. So they've carved it up, but just ignore any of this jumping up and down about the majority of the country has voted one way. They always do. There's always a big 2 to 3 way split in French politics. This is nothing new. By definition, the winner is never the outright majority. They're painting the statistics. It's a shocking performance. And Macron has really messed this up. He's messed up his little European project. Not clever. So it's annoying because the euro is set for a nice little setup. Hopefully we can find a way of people seeing through it. Maybe the dollar weakness will come through and help get us there. But we'll look at that in a minute. So yeah, ADP, which we'd said last week, was only holding up because of leisure and hospitality. Without that sector, the non-farm payroll could have been dangerously close to private and government being the same. I saw, yeah, there was an interesting thing. So just as politics is all over the place and the US politics is there, don't get too hung up on it, because there's only been 2 occasions since the 1950s that an administration of 4 years has ever come back with a negative return. So I mean, it would be very rare. It's only happened when Richard Nixon was in the middle of the Vietnam War and the oil crisis when he had to resign. And then you had George W. Bush ended his period in the middle of the 2000 recession. So that was just bad timing on both their parts, really. And everyone else has managed to eke out gains over their 4-year administration. So we've been talking a little bit about the topping out of the indices and how I was describing it as halitosis. It's bad breath everywhere. It's only been driven by the top few stocks, but they have got earnings. People keep trying to compare it with Cisco in 2000, when back then, if we've mentioned it before, if you had a website, you doubled your market cap. Things were just so crazily hung up on tech. Now these guys are seeing mega earnings upgrades. Obviously, they've got to keep doing that through Q2 and the outlook, but seemingly seeing things come through, it's nothing but new contracts. So you'd expect to see some form of continuation of that trend. You've also got Apple talking about already having details for how AI is going to go onto their hardware and be available as a software option. So every chance that the headlines through this Q2 season are positive. I mean, Nvidia already post that reweight at the end of June has given up 10%. So it's quite a pullback already. That's then you've got things like Tesla. The hedges have been in Hamptons. The first thing they've done since they ventured back. It was short Tesla into their update last week. Well, that's jumped up 26% on the week, actually gone back to being positive on the year. So these things are super, super leveraged and geary, so they can move very, very quickly. We did see a downgrade in Nvidia at the end of the last week from New Street. We've gone to neutral and $135. So, is that enough to top the market out? Well, last week we saw new all-time highs again, driven by Apple, Microsoft, et al. But it's all about the mix. If you get the wrong mixture of the heavyweights being sold and the next sectors down seeing the buying, then by definition, the market might see better breadth, but will actually come off. But that will be a consolidation. I think that still puts us in there. We're close to putting in highs on some of these, which we'll have a look at, and then get a consolidation. But I think we've got one more high for this seasonal effect. Once we get into August, I think is when we get the proper pullback, when we get to the end of this 3-month seasonal period. Obviously, we're playing out at the moment with July. The first 2 weeks of July are normally positive. The first one has been. Let's see how we get on by the end of this week. And this one could end with a nice kicker on the inflation side of things if we're lucky. Things to look for, and Drew, one of the founders, mentioned this to the room on Saturday. Make sure when you're trading indices that you do know what the big market caps are and what the stocks are that move it. And just be aware of what's going on at things like Nvidia. The insider selling at Nvidia is massive. So that means people who own the stock, from the founders to the employees all the way through. Really interesting chart was out there in the marketplace last week that over 75% of employees at Nvidia are worth more than $1 million. And of that, 36% are worth more than 20 million. So at the moment, they've got a bit of an issue that a lot of the top scientists and techies are actually cashing in and just taking retirement because they're set for life. Could that be a problem? So it'd be interesting to see how Nvidia copes with that. And maybe, some of that insider selling and the fact that they're probably going into closed period for any buybacks. And yes, Pav, you've got Nancy Pelosi somehow being allowed to trade around in all these stocks. Well, she could potentially be suggesting policy that may or may not help them. It's quite bizarre, isn't it? That is just shocking, in my opinion, what she gets up to. So just be careful that there's potential for a little bit more all-time high, but we are close to a couple of periods of pullback. So don't think you've got to chase it necessarily in the short term, but certainly play the ranges when they show. And I said, and we'll show it again, the Nasdaq has traded really well within its parallel wave trend lines. You'll keep seeing headlines, Mag 7, Mag 5, etc. Mag 7 are up 48% year to date. Take those out, the S&P is only up 7%. As a result, you'll see lots of people telling you how few, it's a really dangerous time because so few stocks are above the S&P performance for the year. Well, that is a bit disingenuous. It's really, you need to see how many are trading above the 493 performance. The Mag 7 is a little bit of a party all by itself. Russell small cap, though, is negative. Is that just a sign of the times that people want to invest in the bigger, more liquid things? Or is Dow Transport's being poor and Russell 2000 being poor? Is that a sign that the economy is weak? Because it's the small cap firms. If we do ever get a proper sell-off, it will be the reason thrown at the top of the list. But at the moment, I think there are things going on globally like that. For instance, the Nvidia 3 times leveraged ETP or ETF on the LSE has got $200 million under assets under management, which basically means it's the highest traded ETF now, the 3 times leveraged than any other ETF. It's gone past Tesla, which used to be the darling. So it just shows you that even in the UK, people are trading more in overseas stocks via that than they are potentially in a lot of the major issues on the stock exchange. The stock exchange of the UK, again, we'll have a little chat about um, inflows and outflows, but generally there's been outflows from the UK investment scene for something like 39 months in a row or something. I've got the stats somewhere. I did have that somewhere. I'll come across it in a minute. Which is obviously something that the UK needs to sort out because the backdrop is potentially better with the way. I mean, Labour has got this opportunity. I mentioned how they've got to take advantage of it because their percentage of the vote isn't massive. The turnout for voting was only 50% or something, and it was more. A lot of Tory voters abstained. They didn't come to actually vote, so they were punishing them by default. But it does give them a very workable majority that they may be aided and abetted by the Liberal Party on a number of issues. But as long as they remain in that fully costed camp, then they should get rewarded with the bond market behaving, and by definition, sterling can retain some strength, and we might actually get to reverse a lot of that investment outflow. And some of the things up there are to have a UK wealth fund to push through the legislation that requires UK pension funds to at least invest some. But there's a lot of UK pension funds that don't invest anything in UK assets. And if you could somehow tie them into infrastructure bonds directly, then it'd be a win-win all round. And you'd start to see some growth policies. And I just put it back in the preview. I get so fed up with this Liz Truss thing being blamed. There's just a few errant parts of that budget which were to do with uncosted tax cuts that should never have been anywhere near it. The actual premise of what they were doing was a growth policy with a lot of supply side improvements, very much everything the Labour are pushing forward. And the Tories would maybe have been slightly better placed with the city as well to push that agenda through. But they obviously messed it up because they're too busy arguing. But the premise of that is that it is possible to do it. The reason why the effect happened so badly, and I'll explain this because I think it's important for people to know, is that yes, the bond market was a bit pissed off with that budget and how Kwarteng delivered it, but at the very same time, it caused an explosion in was called LDI, which was long-term derivative instruments, liquidity derivative instruments, which were sold to the pension funds and institutional funds as a way of being exposed to the longer end of the bond market without having to own it. So a derivative on long bonds. Hi, Vivek. Good to hear you back. So that caused a really strange nuance. So these are things that sometimes you have to look out for, and the fast money was all over it. The Bank of England had promised for 10 to 15 years to issue at the longer end and sort it out, give all these people somewhere to directly invest in the liabilities that they wanted to be, the assets to offset their liabilities. But instead, they were being encouraged to take up something where you only had to have 25% margin to have a synthetic long gilt. So the situation that happened was, as gilts moved so quickly, it created a situation where anyone that was long of these LDIs suddenly had to put up more margin. Yet the only instrument they had was whatever gilts that they owned. So they were having to sell the gilts that they had to support their bigger exposure that was offside and in loss-making territory in the synthetic side. So it was a self-feeding backward loop that caused all the issues in yields backing up, which was written up as being this disaster for the UK market caused by Liz Truss. So the Liz Truss moment is pretty much a load of nonsense, and it gets swept under the carpet because that would be the Bank of England having to put their hands up to how inept they'd been. But I know people at the Bank of England who told me that had been pushed along the agenda meeting so long until it was inevitable that the first time there was a sharp back up in yields, there was going to be a disaster moment, and that's what it was. So take it with a pinch of salt. It's important to know the details. That's a good chart in there that I've seen a couple of times. Bloomberg Intelligence posted it. There's Gina Martin Adams, who's someone worth following on LinkedIn. She's on my LinkedIn list. Reiterated it. You can see, hopefully, there, or certainly in the preview, You got the 1911 to the Great Depression. You got the 1950s to 68. You got 82 to 2000, and then you got the current bull market since 2009. Obviously, the 2001 went parabolic before it blew up. The 1930s, the 1920s went parabolic before it blew up. But really, we're here on the yellow one. We're at parabolic time. So as much as we're being told that this market is overbought, this is the S&P. It hasn't actually gone to extremes yet. So any pullbacks are probably something that we should be looking at buying. Don't get too hung up on mega crashes just for now. Blackstone investment, 1.4 billion into UK property. Do we see this as money moving to UK or just the housing sector? Well, it's a bit of both, but that's another thing. There is one of the things that the Labour are going to try and do very quickly is change the planning laws, encourage a lot more investment. They're going to do a lot of council houses. And what the house builders have in the UK is massive land banks. They buy a lot of the land way ahead, hoard it, and release it slowly. So the idea is to make them release it a bit quicker, which they won't really mess out on as long as they're allowed to buy more land. But it'll just bring a lot of their cash flows forward. So you'll probably see if the incentives are put out there for that sector will rally, but then people might get worried that it kind of brings them to a high quicker. But we'll see. But I think the fact that it's got inflows into it, it'll win for longer than it loses in the short term. It'll be taken well. So that is a sector that should see a lot of inflows. And there's going to be some immediate help from the government. And they will actually bring back the buy-to-let, or whatever it was called, Help to Buy scheme, to be extended in a number of ways. Where else? What else we got to look at in there? Just quickly shout through that. So yeah, we could do with getting an interest rate cut. Every chance now that the election's out of the way, they'll go for a cut. I think there was a much better chance in the market thought if there hadn't been the election in the way, they may have gone in June. But I think August, they're going to try and find us any way they can. There's so much mortgage renewal coming at the end of the year that could just tip us back into potential recession. They need to get that moving. We talked about politicals. Yeah, it'd be interesting what happens this week. If anyone was watching the news, Port Talbot, Tata Steel have said that they might have to close without government help. So they are thinking of ways of incentivizing government investment alongside some private investment, and then on the basis that Tata Steel can't import its own steel. So this will be quite interesting because they do want to change the infrastructure makeup of the UK. Manufacturing side has just been decimated. Labour may be able to come up with something on that. Yeah, that was it. 37 consecutive months of investment outflows in the UK at the same time that global inflows into risk assets, particularly equities, is going the other way. Yeah, and Tesla said it was up 26%. The hedges were short, so that they probably doubled what the actual real move should have been, purely because they came into it short. I don't really look at Bitcoin. I just noticed that it's on its bum. We should be about to see some what they call liquidation events, liquidity coming from rate cycle changing or getting towards the end of the election backup that we had. We've only really got the states left, haven't we? So we can start looking at the fiscal side of things. And then just generally this week, it is quiet at the front end. We've got Powell Tuesday, Wednesday, CPI Thursday, Friday, and obviously outside that, keep your eye out on Japanese data. We need to see some improvements there. I think we've got some European CPI stuff. I'll have a look at that in a minute. Our Royal Bank of Australia overnight home loans data was rubbish again. We've actually got people are having to sell their houses because their rates are so sticky, actually going up, and there's a big chance they might put rates up again. So look out for strength in Aussie dollar going into August the 6th. Consumer inflation expectations. I can't see. It's a bit like the Michigan thing. I can't see the Australian public having anything other than fears over inflation with the way the data's been coming through. So just look out for little spikes on the Aussie dollar during the week. Just chart-wise, topics, we mentioned it on Friday, all had its highest close since 1989. Hasn't quite taken out the top yet, I don't think. I didn't check it today. But Nikkei and topics both trading towards the top end of historic ranges, and the underlying is good. Currency obviously taking a lot away from me if you haven't hedged it, but it isn't seemingly affecting the underlying stock so much. The Sage of Omaha, Buffett was all over it. We mentioned that last week or during the week. He told us at the yearly update he was in there. So you have every chance to have followed in the great investor and have made a load of money in Japanese mid-cap and large cap. I'll try and go into these charts individually. Hopefully it will show up. Did I run for the elections? Not on mine, Ellie. I've got lots of good ideas. I promise you, things that should have been done over the years. I was in 2008-9 trying to convince people to set up a UK hedge fund, sovereign wealth fund, because we could have literally, with it having to do QE, you could have set up a mortgage side of that, which could have taken one side of the QE thing and at the other side been putting in 1 to 3% mortgages for the whole of the country on a long-term basis, not for speculation, but for your houses, still taking a 1 to 2% guaranteed margin. And in the end, they encourage the private sector to come in, TSBs and things like that. Hasn't really solved any problems. Everyone didn't benefit from the lower rates, and we missed a trick. We should have been all over it with our oil and gas. Should have been investing and creating bonds, infrastructure bonds ourselves. And we should be sat on a bounty of money, really. Looking how the markets have moved since 2009, and we would have probably bought back Gordon Brown's gold as well. So, but ho hum, these things might come again. I know, exactly. It's absolutely ridiculous. Oh, must have been looking at it with one eye. So where are we? Right, on gold, there's two scenarios that we were talking about. Yeah, you're getting used to me now, Fletchley. We're in phase. So we talked last week, there's potential for there being a triangle from the top, which had a 3-wave down for the A. We put 3 waves in for the B. We looked like we'd done C. And then it was a case of, would we get a D and then an E back to the low bit? But because we've got higher lows and higher highs, until that June the 7th was taken out, we could also be nesting for a 1-2. Or we've broken out, and the first wave here from the end of June, 26th to 28th, consolidated, which was that potential truncated E wave, but is more likely to be a wave 2. 5 subwaves making up the 3 to Friday's high. Just happens to be, I said this on the chat, just look at that. So right, it was traded right off the 1.618, which is a classic wave 3, but unfortunately, that's also the extreme of where a consolidation can go to. So you'd have, that could be a 3-wave swing consolidating the move back up from the all-time high sell-off to here. We could have here 3 swings, of which we've got a zigzag, a 5-3-5. So until we take out what's labeled here as the wave 3 high, until there's a new high from that, then we still potentially could be facing another sell-off. It's testing the 50-day moving average again, trying to bounce off it. I do personally think that we are in the 1-2 nesting up and looking for breakout, but we're very close to having put in 5-wave swings of the red wave 1. We need 5 Red one's there to actually put in the third wave. There'll be a consolidation and then a final wave. This all gets me to the still looking for this 2550 idea up here. So we're in the early stages of very quick breakout. All sits potentially with the end of week support from PPI, CPI, blah, blah, blah. But, and I say, you've got to trade it on the actual rules. So a few people have got 2364 to 2350, there's various fair value gaps and blocks and lots of wicks in there. There's obviously the top of the B wave over here, which could be the top of the first wave, depending on which way we're looking at it. But either way, it saw that original backdraft, a lot of selling in that on that particular Friday, wasn't there? We keep getting that. We keep getting this Friday, Monday turnaround using the data to try and bluff the market down. I don't think you should read too much into that perceived China pause because other central banks are in the background. China, from people I've spoken to, have supposedly got an order, had an order below 23 that was hit a few times. So not quite sure what's been going on in their data to suggest that they may be selling it. They may be using that as a signal to try and encourage the market to sell into them. You know, this is not a black and white market. There's lots of stuff going on under the hood. No, gold futures and gold spot will be slightly different because you got to put in the forward rate for the month. The front month, if you're looking at that, will be quite close because there's less time value to play around with. But there's normally a premium just for the cost of carry. Now we've got things that have a high delivery charge or storage charge, then you can sometimes get the negative carry, but it's rare on various instruments. And obviously, this is all the way that the spot market is really affected by the expected future value, which will depend on outer months. Now, just because you buy it during the month of June, you might not necessarily have bought the June contract. You may have bought the July delivery contract, which is potentially why we didn't get the move in June. But as soon as we hit July, we start to see some very spiky movements as if somebody was having to chase it. That's where it can manifest. I said a lot of the open interest disappeared in June, rolling along the curve. A lot went into August rather than July. So that might be a clue that is when we're going to really see the super breakout. And the other factor is historically, because so few contracts were ever taken to physical, you had a big open interest. Open interest has halved in general the last year or so because a lot of players have realised that they might have to deliver and they don't want to be anywhere near that. So it leaves even less of the paper market to try and keep down the physical buyers, which again is why it keeps getting whipsawed, which means getting hit down one way and then getting moved up like a J curve, like a slingshot to the north. So I had another way of looking at that. Yeah, right. Can you see that? So some confluences with fibs relative to channeling, that sort of stuff. So that green channel is a channel that we're playing in at the moment. We had the pink is a background which tells you where the red wave 3 is. So at the moment we're in the 5th wave of this minor wave 3. The relationships for that, looking for the highest fib still available, was 2 spot 618 for impulsive waves, and because it's a third wave, they always tend to be on the spot 618 multiples. Then looking in the subwaves, and I said we're in this 5th wave, but we're about to go into the 3rd blue wave. We're at the early stages of that one. Where does that become multiples of fibs? Well, the 1 spot 618 is 24.22. 2 spot 618 is 2500, and then 3 spot 618 is 2582. So I'm expecting kind of confluence to end up around the 2550. It might overshoot because look, the channel for the minor waves is in green at the moment, just to so it stands out, is up here. So it could actually get to that third extended fib wave and touch the top of the channel. So don't rule that out once this starts going parabolic. But for now, I'm expecting that third wave to probably, once it tests 2500, to have a pause, you get a pullback, and then we'll try and put in to that area of the 2 spot 618 red fib in the top of the channel. So it's a 3, 4, 5 to make the fifth wave up, and we're in the 1 of 5 of that third wave at the minute. So at least 3 or 4 sharp moves up within that left to come. And even then, remember, if I'm talking waves and that's only a 3, you should be thinking, well, that means there's a red 4 and a red 5 even higher, which will give us the next level up. And that itself is in a third wave. If anyone was watching my stuff 3 months ago, 4 months ago, before this broke, we were talking about nesting and how it all starts to unfold, and it's a group of 3s, 3, 4, 5s, and that is what we're still only in the middle of that. So that's why 3000 is definitely in play for the end of the year. Your average dude, thank you for trying. I really don't know how to help you, unfortunately. I'm just told that people mess around with their settings until it eventually works. The playback always seems to be all right from the recording this end. I'm on the maximum that I'm on whenever I'm doing any recording or my risk review stuff, and it isn't normally an issue in that. Maybe because it's coming through from Riverside into YouTube, it's causing some issue, but most people that have been on this for weeks are okay. So I know it's a pain, but please stick with it. I'd love to keep you here. I hope you're not put off. There must be something else that you can do. Right. So everyone happy with gold? I mean, what does everyone else think? I think most people believe the medium term idea. At the moment, it's just where we. Oh right, okay. Well, that could be it, couldn't it? My internet speed should be all right. I'm on fiber. I've got quite a few things open. I mean, for the next one, I will potentially shut some extra stuff down just in case that is driving it for some people my end, but I think it is user end that is the problem. Fato, all guides on my end for audio. So your audio is good, but your predictive text is as bad as mine. Right. So everyone all right with my ideas on gold? And I'd love to hear anyone that's got some good ideas. Bang them on my chat. Let's have a look at the charts. Just have a quick run through while it's still working. All right, dollar wise, that's been working nicely. Still in this crazy 1-2-1-2 down. Within that, very close to having put in the end wave 5. I've got lower lows again today as we're looking for this 3, 4, 5 to finish. 1, 2. So there's still potentially within that maybe one more little move down. We'll just move that further across. That's 3 there. Needs to come to a lower low than that as well. So there's still a tiny bit more dollar weakness before we should have a little move up. Just a small consolidation of maybe, what's that, 0.5% consolidation, and then carrying on with what's hopefully, and again, lining up with later in the week, potential dollar weakness. The charts are telling me there's dollar weakness at the end from all my primary setups. So I'm not necessarily going to fundamentally fight that until something fundamentally changes. Don't want to be biased necessarily, so we will react if things change. But this is ICE data that my one is on. I know some of the CFDs are higher. So yeah, I'm looking at 102 small bounds from that, and then potentially having a look at 100 over the next part of this bullish phase. Remember, if Trump is going to be in the lead as we get closer to elections, there's all these Nobel economists against him talking inflationary. That's it. It's bizarre, isn't it? People telling you how bad he is for the dollar, and yet he's more likely to be. He's being considered inflationary at the moment, but that is a bias of 16 economists of how his policies will trade out. We'll start seeing a lot more two-way analysis of that as we get closer. But anyway, dollar bit choppy, but over the week should be net travel, slightly dovish, if not big dovish by the end of the week. So keep your eye on that. That obviously will support a lot of things. Sterling again, bullish 10 trend intact. I'd written that's even carried on bouncing from that. I think that rather than being a very tiny consolidation there, I think we're just extending this wave. So we're very close to the end of the current sterling move up. They're saying good things, but I'd like to just see consolidation, which sits lovely with what we just talked about in the dollar. If we can buy this into a 3 swing back, I'd love to buy GU and lots of other dollar pairs by the look of it. So don't chase it just yet. I think we're very close to a topping out scenario because that doesn't really matter how much this goes further, because this third wave is the longest that we've got in there. But this could necessarily be third wave here, and we're just putting in a fifth wave until that runs out of steam. Don't blame me if it keeps going, Pav, but I think that we are due a consolidation, and then certainly buy back into it. And that's only there. That's going to be a lot higher than where I've drawn it. That was just to keep it on the chart. That didn't come through, did it? Share this tab. Right, there it is. So, yeah, just saying the middle wave here is already the longest, but it could easily be doing. I've done a fifth wave. That could move to there, and this could be just the short thing. And then we're probably 2/3 of the way through the little move there. Then we're looking for the pullback from wherever it is. 38.20 to 61.80, potential 3-wave pullback while the dollar is consolidating. So again, where does that take us? 127.60-ish is the first idea. 127.40, 30.40. And then it should have a bigger breakout. So euro, surprisingly, hasn't actually done a great deal, has it? Because, as I said earlier in the piece, we got the around here, wasn't it? When did they say it? Last Tuesday, Wednesday, that they were clubbing together. We've had a lot of the rally of the benefits of last night's result. Is this move here being priced in? Obviously, it's all confused at the moment. It's gridlock. I can't really make their minds up. But again, this is in a fifth wave. Probably it's just gone to a new high today. So it's playing out as we thought. Again, that's saying I want that to consolidate. Again, come back to, we've got 2 lower degree fourth waves close to each other. That's a normal area we'd expect consolidation. So again, back to 108 challenge, and then we're off and running, making our way up to 109. I still think we've got 110 in us really for this over the next few weeks, and this is a perfect setup for it today. It'll be dressed up as relief rally. There'll be Macron, who's created this whole thing. it's probably got a little bit out of hand relative to the noisy left within it. He'll find a way of slapping those down, and there'll be some kind of relief rally, but nothing's going anywhere because you've got three parties very close to each other. So France has got a medium-term problem, but it should help with the overall euro bounce. So lots of things all saying different versions of the same thing, I'm afraid, at the minute. So why is that showing that? So I've got my double sharing up. Are you seeing what I'm talking about? Are you getting EU and GU? That's all right. That's just one of these stupid things that's popped up is showing my weekly preview. I just want to make sure you were seeing the right thing. Right. So DAX, again, that's primed for a little bit of relief. Winding its way up. I mean, that again, we're looking for this to keep moving up to put in another high, which is probably going to be in line with NASDAQ and S&P when we look at those in a minute. We haven't at any point taken out this low over here, which we thought we could do while we were seeing sideways action. Starting to get a bit more impulsive. This current 5 waves is looking valid at the moment. Yeah, that looks like a good fit. And then we've had the consolidation down to here. We haven't put a new low in for the current move. We had a 1, a 2, looks like a 3, a 4. So hopefully we go into a little, this looks probably like subwaves of the direction up to this, because the 5th wave all the way to there is hard on to. So we're probably going to get a set of 5 subwaves making this red 5. But it's doing the right shape at the moment. So keep an eye on that. Just checking something. Oh, actually, I want to go back to one thing on gold that we didn't talk about. Right, that chart is the gold-silver spread. So, we talked about silver about to be explosive, and in that cup and handle breakout, in this chart, that means it's going to break this trend line. It's been very close to doing it before. Put in this consolidation recently, momentum likely to build. So if gold is breaking out, silver's going to go right through this. So that's another way of playing it, is having that pair on potentially, of being long silver, short gold. That has got it's likely to have another impulse down. Like this is in what we call impulsive. This is consolidation, and it looks like it's in the early stages of that about to break down. That's impulsive there, consolidation, nesting to potentially break this line down. That gives you an idea of, that could easily halve that ratio, which tells you you're going to get a massive outperformance on silver. Just wanted to make sure that you knew how close we were to that happening. So yeah, Usman, gold to all-time highs, but if that's the case, then make sure you've got a little bit of silver on board as well. That's going to go even more. So looked at DAX, the 225, the Nikkei. That's been our beautiful one, hasn't it? Absolute dream machine. Just think there's potential for that, just as we are flip-flopping around in UJ. We'll have a look at that in a minute. If this is consolidating, we've been doing it for a few days, there's potential that it's always going to come back to the waves of lower degree, but there is potential for that to come down and even another one, do a double, test around with the 40,000 before it goes again. So you know how much I've loved Nikkei. We've called it well. For the minute, I just want to see how this consolidation plays out. I'm not necessarily a bear, but I think there's potential for it to do a little bit more downside than we imagine. So let's get a clearer picture on that before we decide which way to go. It's potentially at a turning point on that, but there is a fifth wave to come. So, and we are messing around with the 50-day moving average. Quite a few things are playing around with 50-day moving average. Want to see that properly bounce off it and a new high before we're convinced of the fifth wave. And again, we've had a number of little overthrows of the 50 that have held, which suggests that original idea here in line with the previous fourth. But we've got time to wait. At the moment, it looks 50-50 short term. Yeah, thank you, Vivek. It's good to have you pop back in. We called it twice, didn't we? Have a go there and have a go over here to make doubly sure that it wasn't going to take out that previous low. That one has actually been, I hope you'll agree for sure, that's been an absolute Elliott wave dream, that it obeyed just about every rule we introduced. So it is a powerful tool, this. I know it can sound a bit convoluted at times, but because we can change our probabilities, we're in the ballpark of what it's going to do if it doesn't do the first one, which helps for anyone that's looking at it for the first time. And I keep saying it, we are going to do more and more basics on that. I'm going to start doing some recording, I promise. FTSE, I want to do the American ones last. So until we get lower lows, this is still nesting. We said it would be the consolidating index. I still haven't had my opportunity to buy it lower down. I know there's some people out there that think this might actually take out the fourth wave low. This consolidation might just be extending, and there might be a final blowout. It's all got a potential. I only really want to buy it every time there's three wave swings. There's been one there, but I'm not in love with necessarily buying it for now. But if you want to buy it, you know where your stop loss is, because if that breaks, we're going to do double that amount of downside, which again brings in the whole area of it being a bigger downside. So that is a powerful turning point there. So you know what you're playing with. And again, if you want to short it, it's going a lot higher if it takes out that high. So yeah, once again, that is a 50-50 two-way pull in the shorter time frame. Don't necessarily have to play that. If I was going to play that, I'd wait until we got a bit closer either way. But yeah, husband, smart silver definitely is. Even if you love gold, and I actually haven't got any silver in me at the moment, and I am going to switch one of my portfolios into some silver just because I keep going on about it and I haven't done it, and that would just really annoy me, as you can imagine. Have we lost the sharing thing again? All right, just a few more minutes. Did you see that FTSE chart at all or not? Yeah, chart's gone on again, isn't it? Right, that should have come back now. Is that back? Got it 3 times now. Yep, cool. So that's come back. Just to go over that again, look, you can see over here that what we had as a fourth wave, it's had a lot of tests, close tests. It could easily be extra consolidation, which will need another low. So what I'm saying is at the moment, it's nesting, but it needs to hang on. Where we are at the moment, you've got two immediate stop losses, either for a buy or a sell, but we're right in between them. I'd prefer to go closer to either one if I was going to be looking for mean reversion. If that one high there gets taken out, I think we are in the nest, and that is going to break out aggressively. That might be towards the end of the week, but equally here, if this stop loss were to go, there's a very good chance that we certainly challenge this too. And if that breaks, we're probably going to go, that's going to be double that move, which is 150 points. You don't really want to be the wrong side of that for no reason. So just be careful. It has been quite a dull sideways move for this one. I did say I was going to do oil, but I've only got halfway through it. I do think we are very close to selling off again, and I'll post that next time. We've done Nikkei. So again, what have we got here? That's a great call if you held on to oil at 60. When was that? That's a long time ago, isn't it? So can you see the Wall Street one? Is that one showing? So that again has had a wave 4 low. We should be in a, thank you, Julie. We should be in a wave 5 at the minute level to make up the minor one. We have had some consolidation. We've had further breakout at the subwaves. Triangles, we say they turn up in the 4th wave. That is very overlappy triangulation. There's every chance that Friday's low was the E wave for breakout to take us up to that. But again, that might end up being further in the week. It's very choppy at the minute. If we get that dollar strength, then we might just continue these sideways waves. But this again is set up for end of the week potential move. But then look, 40,750, 4 or 5% consolidation would be the idea. So we've got to be prepared that we've got some flip-flopping to come. And I said earlier, this is going to be a lot of repetition. So can you see S&P now? Yeah, that's back. So this one, again, is doing the same thing. We just need to see some proper consolidation in it. It's very easy to call that as 5 little subwaves. One, have we done enough for that to be a sub consolidation, or is this actually extending the one? It's grinding up. The net idea is we're grinding up. It's just like all the other indices, but at some point there's some that extra dollar move in here, so we could actually have a deeper consolidation because we're in this trend channel. Remember, it's all too convenient to just keep doing shallow jobbies. Rather than buying this now after it's nearly at the end of what looks like 5 subwaves, it's an index to buy in weakness. So if we do get a move down towards this channel back below 5,500, then buy that. So then I think everything's in your favor for the move up this channel, the 3, 4, 5, and this takes us to the end of the 2-week super period for the S&P. This is the index that all measurements being done on. It should remain net progressive over the first 2 weeks. So even though I've just said I'd like to see a deeper consolidation, that's probably the reason why we're not getting it, because it's in its super risk allocation phase. The first 2 weeks of July seem to get the money. And last but not least, NASDAQ, which has managed to That is a very messy chart as it looks. Okay, that should be showing. So again, we've been grinding up that channel. I've just got this one on just because it's easy to show. That does look like a third wave within it because we've got the highest level at the moment. It's been coming off to the wave 4. We've been moving up to higher highs on lower actual MACD, so it's the classic. But we are moving up towards a fifth of a third wave. So it's getting close to the end of the powerful move. Again, we've got this potential pullback before we go. And again, just where we drew this is all based on projections from weeks ago. It's been playing out nicely. I've got no reason to change it. Then we should get some kind of pullback into August and then a topping out in August, the 3, 4, 5 we've been talking about. Then I think we've got potential for some serious shenanigans going on in September, October, and we know what that is. That's BRICS and Trump. Already, the chart is telling you, and that is the dollar having hit sub 100, hopefully, which makes all this happen. That is when we go back into dollar strength. The Fed fighting the BRICS, Trump coming to fore, ringing Putin up, telling him what to do. Yeah, righto. Anyway, that's all for future weeks, but it already in the setup is suggesting things that we know are already in the fundamental discussion. This is why it's important to consider both. I think I've got an hourly chart on that as well. Is that updated? Just need to get rid of these stop sharing things. Yeah, that's better. So these are the long-term trend channels that we've been working perfectly. So the green one again was the minor waves, and this blue one was the long-term projection for this fifth wave. So they're going into overlapping territory. They're very close to where they're only there because I haven't moved them. So we've hit right where we thought we should see. We're in a fifth wave, looking for 5 waves. I think the third wave is split here. So you got a 1 to there, 1, 2, 3, 4, 5 potentially as a setup. And then we're in the latter stages of this. Takes us to hopefully next week, end of next week, something we're just discussing. So we need to bring it over here. Blah, blah, blah. One final special little go, and then we're into that, what we just looked at on the daily basis. So bit of churning sideways, little explosion at the end of the week. And then that hopefully has been the NASDAQ has been the leading index for this. Hopefully that is when it starts doing its little bit in reverse. So yes, Julie, so what I'm saying is there's room for a little bit of consolidation. It hasn't quite finished this whole move here. It has eked out a tiny little high, so we have to keep in mind that all could be there, but if it's in line with everything else that's going to happen, we get a little bit more. We get that dollar strength, just brings us in here, might make this sideways pattern a little bit clearer. Then we've got one more decisive leg up on the dollar weakness at the end of the week, I think. And then we're into the end of a very substantial, high level, high degree third wave, which is a primary wave. So that should set us up for some form of consolidation. So we'll review that again on Friday. So is that okay? Is everyone all right with that? I think actually might need to move this hourly one a bit further across to match it with the daily one. So yeah, so a bit of grinding through the week to get to over here, isn't it? Yeah, should be over here. Yep, that all makes sort of makes sense to me. We've got a plan, but again, that is, let's see whether we get decisive breakout or we get the pull out first. I'd rather buy all of these things into three-wave pullbacks rather than trying to guess where the top is. You want to be in at the start of the move rather than the end. Blah, blah, blah. So good luck with your trades. Just come on, ask any questions, particularly fundamentals that I can help with. And thanks for sticking with it. Go get them. It's 2:30.